$800 billion. That's how much market value just evaporated from SaaS stocks in a single week. They're calling it the SaaS-pocalypse. Salesforce down 26%. Adobe down 43%. ServiceNow down 31%. Intuit down 33%. Wall Street is asking a terrifying question: what if AI agents kill the entire SaaS? Here's what triggered the panic. In early February 2026, the software sector entered a full-blown bear market. The catalyst was something called seat compression. For decades, SaaS companies charged per user, per month. Salesforce charges $150 per seat. Adobe charges $80 per seat. That model only works if companies need lots of human seats. Enter agentic AI. When Anthropic released Claude Cowork and OpenAI pushed its autonomous agents, enterprises realized something devastating: 3 AI agents could do the work of 100 employees. Suddenly, CIOs don't need 100 Salesforce licenses. They need 10. That's a 90% drop in seat revenue for the same output. Jefferies Trading Desk coined the term SaaS-pocalypse. Piper Sandler started downgrading stocks. Goldman Sachs called it overblown. And now, software price-to-sales ratios have compressed from 9 times to 6 times, levels not seen since the mid-2010s. But is the panic justified? Let's look at each company. Salesforce is the poster child for this crisis. The stock dropped 26% as investors panicked about seat compression in sales and marketing. But here's what the market is missing. Salesforce isn't just sitting there waiting to get disrupted. Their Agentforce platform is growing at 330% annually with $540 million in ARR. They've closed over 18,000 Agentforce deals and processed more than 3 trillion tokens. Revenue last quarter was $10.3 billion, up 9% year over year. Non-GAAP operating margin hit 35.5%. Free cash flow grew 22%. They raised full-year guidance to $41.5 billion. And CEO Mark Benioff has set a long-term target of $60 billion in organic revenue by fiscal 2030. The key question: can Agentforce 10 cents per action pricing offset the loss of $150 per month seats? It's too early to say definitively, but the early momentum is explosive. At current prices, analysts have an average target of $328, about 40% upside. ServiceNow might be the strongest positioned of the 4. Despite dropping 31%, this company just posted 21% subscription revenue growth and guided for 20% growth in 2026, well above what analysts expected. Total revenue hit $3.6 billion in Q4, up 20.5% year over year. Free cash flow margin was 57%. That's extraordinary. Their AI product, Now Assist, already has $500 million in ACV and is tracking toward $1 billion by end of 2026. Consumption growth is up 55 times. And they're making aggressive strategic moves, acquiring Armis to triple their security market opportunity and Visa for identity security. CEO Bill McDermott put it bluntly: there is no AI company in the enterprise better positioned than ServiceNow. The stock trades at 28 times forward earnings and 7.5 times forward sales. For a company growing revenue at 20% with 57% free cash flow margins and accelerating AI adoption, that's starting to look genuinely cheap. 44 analysts rated a strong buy. Adobe has been the hardest hit. The stock is down 43% in the last year. The fear is simple: generative AI tools from Canva, Google, and open source alternatives are eating into Adobe's creative monopoly. But look at the actual numbers. Adobe delivered record revenue of $23.8 billion in fiscal 2025. They're guiding for $26 billion in fiscal 2026 with over 10% ARR growth. Non-GAAP EPS is projected at $23.30 to $23.50. Their Firefly AI platform has been adopted by over 35% of Photoshop users. They're monetizing AI through generative credits, creating new consumption-based revenue streams alongside subscriptions. And here's the kicker: Adobe trades at just 14 times fiscal 2026 earnings. For context, large-cap software peers trade at 26 times. Adobe is being priced like a dying company when it's actually growing revenue at 10% with 45% target margins. The average analyst price target is $414, implying roughly 50% upside from current levels. Intuit rounds out our analysis. The stock is down 33% in 2026 despite delivering an exceptional first quarter, revenue up 18%, earnings up 34%. Credit Karma grew 27%. QuickBooks Live customer growth surged 61%. And TurboTax Live grew 51%. Their AI strategy is working. Intuit's virtual AI agents have reached 2.8 million customers. Their accounting agent saves users 12 hours per month. Their payments agent helps businesses get paid 5 days faster. The mid-market play is accelerating with 40% revenue growth in QuickBooks Advanced and the Enterprise Suite, disrupting legacy ERP systems. Full-year guidance calls for $21 billion in revenue, 14 to 15% earnings growth, and expanding operating margins. At 22 times forward earnings, Intuit looks attractive for a company with this kind of diversified moat across tax, accounting, payments, and marketing. Analysts have a median target of $800, 60% upside. Let me put all four side by side. Revenue growth, ServiceNow leads at 20%, followed by Intuit at 12 to 13%, Adobe at 10%, and Salesforce at 9%. Free cash flow margins, ServiceNow dominates at 57%, Salesforce at roughly 22%, Adobe targeting 45%, and Intuit in the mid-30s. AI momentum, Salesforce has the most explosive Agentforce growth at 330% ARR growth. ServiceNow's Now Assist is scaling fastest in consumption. Adobe is monetizing Firefly through creative workflows. And Intuit's AI agents are driving measurable customer outcomes. Valuation, Adobe is the cheapest at 14 times forward earnings. Intuit and ServiceNow are in the low to mid-20s. Salesforce is moderately valued with the most upside implied by analyst targets. Each stock has dropped 25 to 43%. That's a lot of bad news already priced in. Here's why the SaaS-pocalypse narrative is overblown. First, all four of these companies are actively building AI products. They're not getting disrupted from outside, they're disrupting themselves. Agentforce, Now Assist, Firefly, Intuit AI agents. These aren't vaporware. They're generating real revenue. Second, the per-seat model isn't dying, it's evolving. Companies are shifting to consumption-based and outcome-based pricing. Salesforce charges 10 cents per agent action. Adobe sells generative credits. This could actually expand total addressable markets rather than shrink them. Third, enterprise software has enormous switching costs. You don't rip out Salesforce or ServiceNow from a Fortune 500 company overnight. The installed base is massive and sticky. Fourth, valuations are at multi-year lows. Software price-to-sales ratios at 6 times haven't been seen since the mid-2010s. Goldman Sachs CEO David Solomon called the sell-off too broad. JP Morgan sees a rebound based on overly bearish AI disruption pricing. When the smartest money on Wall Street says things are oversold, that's worth paying attention to. But let's be honest about the risks. First, seat compression is real. If AI agents reduce headcount at enterprise customers by even 20 to 30%, that's a massive hit to per-user revenue that consumption pricing may not fully offset, at least not in the short term. Second, the competitive landscape is shifting. Open-source AI tools are getting better every month. Smaller, nimbler competitors can build products that do 80% of what Adobe or Salesforce does at a fraction of the cost. Third, IT budgets are being redirected. CIO surveys show budget growth decelerating to 3.4% in 2026, and the funds that are growing are going to AI infrastructure, not application software. That's a direct headwind for SaaS spending. Fourth, multiple compression may not be over. If growth rates decelerate further, So here's my ranking. Number 1, ServiceNow. Best growth at 20%, best margins at 57% free cash flow, strongest AI scaling with Now Assist, and the most defensive enterprise positioning. At 28 times earnings, it's a buy. Number 2, Intuit. Most diversified moat across tax, accounting, payments, and marketing. 18% revenue growth last quarter, AI agents reaching millions of customers, and trading at just 22 times earnings. Also a buy. Number 3, Adobe. The deepest value play at 14 times earnings. The risk is higher because of creative AI competition, but at this valuation, a lot of bad news is already priced in. It's a watch with upside if Firefly monetization accelerates. Number 4, Salesforce. The most dependent on the seat model, but Agentforce momentum is undeniable. 9% revenue growth is the slowest of the four, but the pivot to AI is real. At current prices, it's a watch with potential to upgrade if Agentforce inflects revenue growth higher. That's the full breakdown on the SaaS-pocalypse, Salesforce, ServiceNow, Adobe, and Intuit. Is this the death of SaaS or the buying opportunity of a decade? The answer depends on execution. Head to stockfortress.com to run your own free analysis on any of these stocks. Get the financials, the risks, the valuation, everything you need to make informed decisions. Stock Fortress, invest smarter.